Good morning, dear students. Today we're gonna start discussing chapter 2, the recording process. And through this chapter we will cover the following objectives. Number 1, describe how accounts, debits and credits are used to record business transactions. Number 2, indicate how a journal is used in the recording process. And objective number 3, explain how a ledger and posting help in the recording process. And finally, objective number 4, prepare a trial balance. As you remember, in chapter 1, we analyzed business transactions in terms of the accounting equation, assets equal liabilities plus owner's equity. And we presented the cumulative effects of these transactions in a tabular form. However, in order to record each transaction using the same form as we have made in our prior example of SoftBite Corporation, it would be impractical and also expensive and unnecessary to keep tracking of these transactions, because the companies will engage in thousands of business transactions in a single day. Thus, companies use a set of procedures and records to keep track of transaction data more easily. And this chapter will introduce and illustrate these basic procedures and records. So let's start discussing objective number 1. Describe how accounts, debits and credits are used to record business transactions. In this objective, we're going to explain how debits and credits work and what did they mean in the first place. So let's go ahead and start by saying what does a debit mean? When I ask you, could you define a debit for me, you will say debit means left. And if I ask you to define a credit for me, you will say credit means right. So again, debit means left and credit means right. But what do we mean by left and what do we mean by right? Okay, we're going to deal by something called a T account. As you see here, there is this T account. And why we call it a T account? Because as you see, it looks like a capital T letter. And the T account has a left side and a right side. Here is the left side, which is the debit side. And also it has a right side, which we call it the credit side. So again, we have a T account with a debit side, and this debit side means left side. And also we have a right side, and we call the right side credit side. Both have the same meaning, right or credit side, and left or debit side. And that's all what credit and debit means. But the T account of what? The T account of an account. But what's meant by an account? Let's have an example. We have stated before that we have several assets account. For example, we have a cash account, equipment, land, building, account receivable. And also we have several liabilities items or several liabilities accounts. Like accounts payable, notes payable, salaries payable, and so on. So, for example, if we are talking now about an equipment as an account, once you buy an equipment, your equipment account will go up. And when you sell the equipment, your equipment account will go down. So, this account means it keeps tracking of any increase or decrease in a specific asset or a specific liability or owner's equity. So again, the account means record, keeping record of increases and decreases in a specific asset account. For example, in equipment account, cash account, account receivable account, all of this you are keeping a tracking of what happened in this account. When you buy a land, your account will increase. And when you sell the land, your account will decrease. If we are talking, or if we are preparing a T account for cash, the same will happen. When you add cash to the business or add cash to the company, your account will increase. And when you withdraw cash from the company, your account will decrease. So again, the account means keeping a track. It keeps tracking of any increase or decrease, any change in a specific asset or in a specific liability, owner's equity, revenue, and expenses items. So you're gonna keep track of all your liabilities. You're gonna keep track of accounts payable. You're gonna keep track of notes payable, your salaries payable, and so on. And you're gonna keep tracking of your owner's equity account, revenue, expenses, in addition to owner's capital and owner's drawing. Thus, you should know what are assets account, and you should also memorize as all assets account, all liabilities account, and all owner's equity account. So again, to summarize this point, you have to understand that an account is an individual accounting record. It's an individual accounting record of increases and decreases in a specific asset. It may be cash, equipment, land, building, account receivable, or any specific liability, accounts payable, notes payable, and so on, and also any specific owner's equity item. And in its simplest form, an account consists of three main parts. A title or the account name. Here, the title or the account name, we can call this cash account, or we can call it account receivable account, or we can call it equipment account, and so on. For if you are talking about liabilities, I can call this account notes payable account, owner's capital account. So you will prepare a separate and individual account for each asset, each liability, each owner's equity account. So the T account consists first from the title, account name, which is here. You have to write first the name of the account, then the left side, which is here, we can call it debit or DR as an abbreviation, and a right side or a credit side, we can call it credit or CR as an abbreviation. And again, because the format of an account looks like letter T, we will refer to it as a T account. Okay, debit and credit procedures. In Chapter 1, you learned the effect of each transaction on the basic accounting equation. And remember that we have a double entry system. And what's double entry? It means that each transaction must affect two or more accounts to keep the basic accounting equation in balance. So if you remember, we have said before, if there is any increase in the assets in the left-hand side of the accounting equation, there should be a corresponding increase in the right-hand side of the accounting equation, which can be increase in liabilities or increase in owner's equity. And also, if there is any decrease in assets in the left-hand side of the accounting equation, it should be followed by a decrease in liabilities, a decrease in owner's equity account, or, a decrease in liability or a decrease in owner's equity, or increase in assets in order to maintain the equality of the accounting equation. So at least two accounts will be involved. So the double entry system, as you see here, each transaction must affect two or more accounts to keep the basic accounting equation in balance, to maintain the equality of the accounting equation. Recording is done by debiting at least one account and crediting at least one other account. What is meant by this? It means for each transaction, debits must equal to credit side, and the equality of debit and credit provides the basis for the double entry system of recording transactions. The double entry system for determining the equality of the accounting equation is much more efficient than the plus and minus procedure we used in chapter 1. So again, double entry system, it requires or it means that 2 or more accounts will be affected. And it also indicates that debit side must equal to credit side in each transaction. So, if the sum of the debit interests are greater than the sum of the credit interests, the account will have a debit balance. Now we are dealing with one account. To be more specific, I'm going to call this account cash. We can call this account cash account. And as you see, the cash account has transaction number 1. Transaction number 1 was debited. So we put the $10,000 in the debit or the left-hand side. Then we have transaction number 2, which credited by $3,000 in the right-hand side. And then transaction number 3 also was debited by $8,000. And I'm only just reading one account. And again, this is the T account for only one account, which is cash. I'm just showing you how to read the account, okay? So if we added the debit side, 10,000 plus $8,000, it will give us 18,000. And if we added the credit side, we only have now the sum of the credit side is $3,000. And I asked you, what is the balance for this account? Is it a credit balance or a debit balance? Again, if the sum of debit interests are greater than the sum of the credit interest, the account will have a debit balance. So in this case, we have $18,000, the sum of the debit interest, which is greater than the sum of the credit interest. In this case, we will have here the debit balance by the difference, which is $15,000. So again, if the sum of a debit entry is greater than the total amount in the credit interest, your balance will be a debit balance. Okay, what if the sum of credit interest, it is the opposite of what we have discussed. If the sum of credit interest are greater than the sum of debit interest, the account will have a credit balance. So here, transaction number 1 was debited by $10,000. Then we have transaction number 2 in the credit side by $3,000, and transaction number 3 by $8,000 in also the credit side. So if we add on the debit side, we will come up with $10,000. And if we added the credit side, we will come up with $11,000. So the total or the sum here, $11,000. In this case, the account will have a debit balance or a credit balance. I have stated before, if credit interest is greater than debit interest, the account will have a credit balance by the difference. So here, the balance will be in the credit side by how much? By $1,000. The difference between $10,000 and $11,000 will provide us with a credit balance $1,000. However, it's very important to understand that the term debit or credit by itself doesn't mean increase or decrease. Whether a debit or credit is an increase or decrease, it depends on the account itself, the type of the account. But the definition of debit is left side, and the meaning of credit, it means right side. Never say that debit means increase or credit means decrease or the opposite. And also you should learn the difference between total debit and credit for an account, which is the account balance. So the difference between the debit side and the credit side is called account balance. And again, when the sum of the debit side, if the sum of the debit side is greater than the credit side, the account balance will be in the debit balance or in the debit side. And when the sum of the credit side, if the sum of the credit side is greater than the debit side, here we say that the account has a credit balance. Okay? So let's take a look at our account categories. What we have learned so far is that we have assets, we have liabilities, and we have a whole category that we call it owner's equity. And under this category, we have owner's capital, owner's drawing, revenues, and we have expenses. You can think that we have 6 different accounts, and here's what you need to learn regarding these categories, and you have to memorize these rules very well. First, assets. In case of assets, all assets account will have a debit side when you increase assets. So, if there is increases in assets, it will be in the debit side. Any increase in asset will be added or recorded in the debit side. However, any decrease in assets will be credited. What are assets? Assets is our cash, supplies, equipment, land, building, account receivable. All assets, when you increase them, you debit them. And of course, the opposite is true. So when you decrease assets, you will credit them. And this is the first rule. You should memorize this very well. Any increase in assets will be debited, and any decrease in assets will be credited. When your asset increases, write them in the debit side. When your asset decreases, write them in the credit side. But what is the normal balance for all asset accounts? The normal balance for all asset accounts is in the increase side. So the normal balance is on the increase side. So asset increase in the debit side. Any increases is recorded in the debit side, and here is the normal balance. What about liabilities? When your liabilities increase, you credit liabilities. Any increases in accounts payable, in notes payable, in salaries payable will be credited. And when liabilities decrease, you will debit them. So any decrease in accounts payable, any decrease in notes payable, in any liability account will be debited. Therefore, the normal balance for all liabilities account will be the credit side. Why we said that the normal balance will be in the credit side for liabilities? Again, because I have stated that the normal balance is on the increase side. And in case of liability, the increase side is in the credit side, so the normal balance is here. While in case of assets, the increase side is the debit side, so the normal balance will be here. And it will take you a short while to become accustomed to using terms debit and credit. But with practice, you will master the concept easily. What about owner's equity? As indicated in Chapter 1, that owner's investment and revenue increase owner's equity, so credit them. While owner's drawing and expenses decrease owner's equity, so we will debit them. Many companies should keep account for each of these types of transactions. Thus, when there is increase in owner's capital, you should write this amount in the credit side. So when there is any increase in owner's capital, it will be credited. When there is any decrease in owner's capital, you will write it in the debit or the left side. And again, in this case, what is the normal balance in owner's capital account? The normal balance we have stated before here, that the normal balance is on the increase side. So the normal balance will be, in case of owner's capital, in the credit side. While the opposite is true for owner's drawings, which occurs when an owner withdraws cash or other assets for his personal use. Increases in owner's drawing will be debited. Any increase in owner's drawing, once you withdraw cash from the company account to your personal use, you will debit this transaction here. Your owner's drawing, when your owner's drawing increases, it will be debited, and decreases will be credited. And again, what is the normal balance? The normal balance is always in the increase side, and in the case of owner's drawings, the increase side is here, so the normal balance for owner's drawing is the debit side. Regarding the other two categories of owner's equity, as you know that the main purpose of earning revenues is to benefit the owners of the business. The main purpose of earning revenue is to benefit the owners of the business. That when a company recognizes or records revenues, owner's equity increases. Therefore, the effect of debit and credit on revenue account will be the same as the effect on owner's capital account. The effect of revenue will be the same as owner's capital. And we have stated owner's capital increases in the credit side and decreases in the debit side. The same for revenue. Revenue increases, when revenue increases, you will write them in the credit side. And when they decrease, debit them. And what is the normal balance? Again, the normal balance is in the increase side. And here, credit side is the normal balance for revenue. While expenses have the opposite effect. And as we know, expenses decrease owner's equity. Since expenses decrease owner's equity and revenues increase owner's equity, it is logical that the increase and decrease sides of expense account will be the opposite of revenues account. So when your expenses increase, write them in the debit side. And when your expenses decrease, write them in the credit side. So now, what is the normal balance for expense account? The normal balance will be in the debit side. Why? Because expenses increases in the debit side, so it will normally show here. So again, it's very important to memorize these rules very well. First, assets increase in the debit side and decrease in the credit side. The opposite will occur for liability. Liability increase in credit side and decrease in the debit side. Then we have owner's capital. Owner's capital increase credit side. Owner's drawing, the opposite, increase in the debit side. Revenue increase in the credit side. Expenses increase is the opposite of revenue, so it will increase in the debit side. And again, when I ask you what is the normal balance for any account, the normal balance will be in the increase side. So expenses, the normal balance will be here because expenses increase in debit. While revenue, normal balance will be here because revenue increases in the credit side. Debit increase both assets and liability. What do you think? Debit can increase both assets and liability? Of course no. We have stated that debit may increase assets, but debit decrease liability. So debit increase assets and decrease liability. Debit decrease both assets and liability? No. Increase assets and decrease liabiliity? True. Decrease assets and increase liability? No. So the choice will be C, letter C. Accounts that normally have a debit balance are, what are the accounts which have a normal debit balance? We have stated the debit balance is in the increase sign. The normal balance is the increase sign. So which account will normally have a debit balance? Assets have a debit balance because assets increase in the debit side. Expenses also will have a debit balance because it increase in the debit side. Revenue will have a credit balance because it increase in the credit side. So no. Letter B, assets, expenses and equity. Equity has a credit balance because it increase in the credit side. C, assets, liabilities and owner's drawing. Again, liabilities increase in the credit side. D, assets increase in the debit side. Owner's drawing is the same, increase in the debit side, and expenses also increase in the debit side, so the choice will be letter D. So the relationship among the assets, liabilities, and owner's equity of the business will be as you see. The basic accounting equation is assets equal liabilities plus owner's equity. And the expanded equation is assets equal liabilities plus owner's capital minus owner's drawing plus revenues minus expenses. What about the debit and the credit effect? If we are talking about assets, we will say that any increase in assets are debited. Any increase in assets are debited. And again, what is the normal balance of assets? It is in the increase side, so it will be here. What about liabilities? Any increase will be credited while any decrease will be debited, and the normal balance is here in the increase sign. Owner's equity, equity is very tricky because we have 4 accounts affecting equity. The first account is owner's capital. Any increase in capital is credited. Any decrease in capital is debited. The normal balance again is here in the increase sign. While any increase in drawings is debited, and any decrease in drawings will be credited. Drawing is the opposite of owner's capital, and the normal balance here in the debit side, in the increase side, will be here. While owner's capital, the normal balance will be in the credit side. Revenue, we have stated before, revenue has the same effect of owner's capital. So it increase in the credit side, decrease in the debit side, and the normal balance is in the increase side, which is the credit side. Expenses is the opposite of revenue. It will increase here in the debit side and decrease in the credit side, and the normal balance will be in the increase or the debit side. In this case, in the debit side. And again, you have, it will take you a short while to become accustomed to using the term debit and credit, but with practice you will master these concepts very easily. Let's do this exercise to make sure that you got the idea of normal balances. Kate Brown has just rented a space in a shopping mall. In this space, she will open a hair salon to be called Hair It Is. A friend has advised Kate to set up a double entry set of accounting records in which to record all of her business transactions. Identify the balance sheet accounts that Kate will likely need to record the transactions needed to open her business transaction. And indicate, you are required also to indicate whether the normal balance of each account will be debited or credited. Okay, Kate will have the following asset accounts: cash, supplies, equipment. And what is the normal balance for the assets? We have stated before that assets increase in the debit side and decrease in the credit side. So, and the normal balance will be in the increase side. So in this case, it will be in the debit side, the normal balance for all assets account. Also, Kate will have the following liability account: notes payable and accounts payable. And what is the normal balance for these accounts? Liabilities increase in the credit side here and decrease in the debit side. The normal balance will be in the credit side here. And finally, only owner's capital as an equity account will be needed when Kate begins a business. What is the normal balance for owner's capital account? We have stated before that owner's capital account increase in the credit side and decrease in the debit side. This is the debit side, TR, and this is the credit side. So the normal balance will be here in the increase side or the credit side. Okay, let's do another exercise, which is mainly from the textbook on page 24 to make sure you understand this objective. Which of the following statements about an account is true? The right side of an account is the debit or increase side. No. The right side is the credit side. Never say on a debit or a credit increase side. Debit means left and the credit means right. An account is an individual accounting record of increases and decreases in a specific asset, liability, and owner's equity item. True, this is the definition of an account. Account will provide you with a summary with an individual record of any, it mainly will track any increase or decrease in a specific asset account, such as cash, equipment, account receivable, or any specific liability such as accounts payable, notes payable, salaries payable, or any individual owner's equity account. There are separate accounts for specific assets and liabilities, but only one account for owner's equity item? No. There are separate and individual account for all assets, for specific liabilities, and also for each item or each owner's equity item. The left side of an account is the credit or the decrease side. Again, never say that the credit means decrease or debit means increase. The left side means debit, and the credit side means right. So the choice will be letter B. Debits increase both assets and liability. Debits increase assets only. Debits decrease both assets and liability. No. Debits increase assets and decrease liability. This is true. D, decrease assets and increase liability. No. So we have stated before that debit assets will increase here and will decrease in the credit side. And we have stated also that liabilities increase in the credit side and decrease in the debit side. So debit, increase assets, and decrease liability. A revenue account is increased by debit. Revenue account, let's write the revenue account. Revenue account, increase in the credit and decrease in debit. So it is increased by debit? No. Is decreased by credit? No. Has a normal balance of debit? No. Is increased by credit? Yes. Letter D is increased by credit, as we see here. Accounts that normally have debit balances are assets, expenses, and revenues. Assets normally have a debit balance because it increases in the debit side. Expenses normally have a debit balance because it increases in the debit side. While revenue normally have a credit balance because it increases in the credit side. B. Assets, expenses, and owner's capital. Owner's capital have a credit side because it has a credit balance because it increases in the credit side. Assets, liabilities, owner's drawing. Liabilities also has a normal credit balance. Assets, expenses, we have said yes, and owner's drawing, yes, because owner's drawing increase in the debit side, so it will have a normal debit balance. So choice will be D. The expanded accounting equation is assets plus liabilities equal owner's capital plus owner's drawing plus revenue plus expenses, for sure no. Assets equal liabilities plus owner's capital plus drawings plus revenue minus expenses, no. Assets equal liabilities minus owner's capital minus drawing minus revenues minus expenses, for sure this is no. D, letter D, assets equal liabilities plus owner's capital minus drawings because it decreases owner's capital equity plus revenue because it increases owner's equity minus expenses because it decreases expenses decrease owner's equity. So the choice will be letter D. And of course it is a very simple question. Okay, another exercise from is a textbook in page 34, exercise 2.1. Chem has prepared the following list of statements about accounts. Identify each statement as true or false. First, an account is an accounting record of either a specific asset or a specific liability. Is this a true statement? An account is an accounting record of a specific asset or a specific liability. We have stated that an account is a record or a summary of increases or decreases in a specific asset, liability, or owner's equity, revenue, and expenses. So this is false. An account shows only increases, not decreases, in the item it relates to. An account, we have stated that it shows both increase and decrease in the items it relates to. So this is false. Some items such as cash and account receivable are combined into one account. No, we will prepare a separate account for cash and also a separate account for account receivable. So there is no combined accounts for any item. An account has a left or a credit side and a right or a debit side. We have stated before. Any T account we have here DR, which is a debit, and a credit. This is the left and this is the right. So an account has a left or a debit side and a right or credit side, which is false. A simple form of an account consisting of just the account title, the left side and the right side is called the account. Yes. This is a simple form of any T account. The title of the account, the left hand side, which is the debit side, and the right hand side, which is the credit side. Okay, this practice brief exercise is in the textbook in page 26. Transactions for Warren Porter Company for the month of May are presented below. Identify the accounts to be debited and credited for each transaction. Let's start by the first transaction, which is on May 1st. Warren Porter invested $22,000 in the business. This means that when you invest cash into the business, so cash will increase. And also, your capital will increase. So in this case, we are required to state the debit and the credit account. Investment will increase cash, and when cash is an asset. When cash increase, what happened? We will debit any asset. So cash increase, debited. And on the other hand, capital increase, owners capital. And the rules say when owners capital increase, credit. May 6, Warren Porter paid office rent of $900. So we paid cash. When cash or asset decrease, you will debit it or you credit it. For, of course, cash as an asset, decreased, it will be in the credit side. And we paid rent expense, so rent expense increase, it will be written in the debit side. On May 12, Porter performed consulting services and billed client $4,000. So we performed a service and we sent the bill, we sent the invoice to the client by $4,400. So we have now service revenue. We will recognize a revenue because we performed a service. And revenue, our revenue increase, and we have stated based on the debit and credit rules. When revenue increases, it will be debited or credited? It will be credited. So service revenue increase, it will be written on the credit side. What about the debit or the left-hand side? Did you receive cash? No. We send the bill and we are expecting to receive this cash from the client in future. So now we have something called account receivable. Our account receivable increased, which is an asset. And when asset increase, we debit. This is in May 1st, May 6th, May 12th, and then May 18. On May 18, Warren purchased equipment on account for $1,200. We purchased something on account. When you buy something, you should first determine, did we pay cash for this item? No. We bought this item on account, so we have a liability. Our liability increased. When liability increased, will be credited. We bought something on account, so we have now accounts payable. Accounts payable is a liability, and our liabilities increased, so we will write them in the credit side. Did we pay cash for this transaction? No. So we have an obligation to pay this in future. And at the same time, we have said before that there should be a double entry. If you, in any transaction, if you debited an account, you should credit the account by the same amount. So we bought equipment, we purchased equipment, our assets mainly, increased by this value. So equipment will be written in the debit side and accounts payable liability will be written in the credit side. Let's have another exercise. Brief exercise 2.1 in the textbook. For each of the following accounts, indicate the effect of a debit, credit on the account and the normal balance account. So you are required here to determine what is the effect of debit and what is the effect of a credit on the following accounts, and what is the normal balance of each of these accounts. Let's start by number 1, accounts payable. Accounts payable, we have to state A, the effect of the debit, B, the effect of the credit, and C, the normal balance. Accounts payable, we have stated before, the debit and the credit rule indicates that accounts payable as a liability or liabilities increase in the credit side. So credit means the effect of credit or the effect of the accounts payable here, it increase in the credit side, and vice versa, or the opposite, it will decrease in the debit side. What is the normal balance for accounts payable? We have stated before, the normal balance is on the increase side, so the normal balance will be credit, since accounts payable increase in the credit side. 2. Advertising expense. Advertising expense, any expense, we have stated that expenses is the opposite of revenues, and expenses increase in the debit side, so the effect here will increase and decrease in the credit side. What is the normal balance? Normal balance is the increase side, debit. 3. Service revenue. Service revenue increase in the credit or the debit. Service revenue is the opposite of expenses. So decrease in the debit side, increase in the credit side. The normal balance is the increase side in the credit. 4. Accounts receivable. And account receivable is considered as an asset. So assets, all asset account increase in the debit side and decrease in the credit side, and the normal balance is in the increase side, debit. Five, owner's capital. Owner's capital, the same as revenues. Increase credit side, decrease in the debit side, and the normal balance is here, credit. Six, owner's drawings. Drawings is the opposite of capital. It increases in the debit side and decreases in the credit side, and the normal balance is in the debit side. It will be here in the debit side. So you should notice that drawings, expenses, account receivable is considered as an asset. All these three items or three accounts have the same effect of debit and credit, and also the normal balance increases in the debit side here. Account receivable increase in the debit side, expense increase in the debit side, and also drawing increase in the debit side. They decrease in the credit, decrease in the credit, decrease in the credit side. Normal balance, debit, debit, debit balance. Okay? Brief exercise 2-2. Transactions for Allingthorne Company for the month of June are presented below. Identify the accounts to be debited and credited for each transaction. Let's start by June 1st, the first transaction. June 1st, we have to state what is the debit account, which item is debited, and which item will be credited. On June 1st, Allingthorne invests $5,000 cash in a small welding business of which he is the sole proprietor. So this means that the owner made an investment. So he added capital, or he added cash to the business. In this case, our cash, our asset will increase. And when assets increase, it will be written in the debit or the credit side for sure. Cash increase, so it will be written here. What about the credit side? What about the double entry effect? Capital increase, and when capital increase, it will be in the credit side. June 2nd. Purchases equipment on account for $3,600. We bought something on account, so now we have a liability. liabilities increases in the credit or the debit side, we have an accounts payable in the credit side. And at the same time, we purchased equipment. So equipment increases, and when assets increase, we should write it in the debit side. 3. Cash, $800 cash is paid to landlord for June rent. So we paid cash. When our cash increase, we write it here in the debit side or in the credit side, because cash is an asset. Decrease, you should write it in the credit side. And at the same time, we have expenses. Mainly, it's rent expense. Rent expense increase, it will be written in the debit side here. Transaction on June 12. The owner sends a bill to Johnson for $400 after completing welding work done on account. So we send an invoice to a customer, to a client, for $400 after completing welding work done on account. So we performed a service. When you perform a service, you have now service revenue. Service revenue increases in the credit or the debit side. Of course, service revenue increase in the credit side. What about the debit side? Did you receive cash? No, but I'm expecting to receive this cash in future. We have account receivable. By how much? Account receivable mainly is an asset. So when our asset increases, it will be written here in the debit side. So again, it is very important to memorize the credit and debit rules, and we have stated before that assets increases in the left-hand side and decreases in the credit side. Liabilities and owner's equity, both of them will increase in the credit side and decrease in the debit side. But you should notice that owner's equity is very tricky, because we have 4 accounts, 4 items affect or cause a change in owner's equity. So we should determine first, is it a revenue? Because revenue and owner's capital, they have the same effect. Revenue and owner's capital increases in the credit side, as you see here, and decreases in the debit side. While the other 2 items affecting owner's equity are drawing and expenses. And drawing and expenses, we deal with them or they have the same effect. When drawing and expenses increase, you should debit them, or you should write them in the debit side. And when expenses and drawing decrease, you should write them in the credit side. This is for today. We also will discuss this in our face-to-face lecture, and thank you.